All right, it is noontime, and we thank you all for joining us this afternoon. We have some great guests with us. We'll officially get started in a second, but as we know, people typically will join a couple of minutes late and whatnot. So what we're going to do first is give you a top 10 list of financial mistakes people make, the most common ones. And the first one is excessive and frivolous spending. So it could be that you're buying things on a monthly basis or every few months that is a large expenditure, or it could be the small ones that add up, right? Young people oftentimes they learn a little bit too late that if they just save their money on coffee on a regular basis on something else rather than coffee every single day, they would have some extra money at the end of the year, right? For the real purchases they want to make. So. And then, the thought comes back to that Mark Twain saying where we often buy things we don't need with money we don't have to impress people we don't even like, right? I love that saying because it's so true. And even if you do impress someone, how long are they impressed, right? Before they become jealous. And then who knows what they're going to do after that. So the number two is never ending payments. You get into a car loan for a car that's over your budget, and you got like a long-term loan on that, like 7 years, or you go out there and you buy a house and it's going to be for 30 years, and you don't figure out that you could make extra payments and try to reduce that. And I've seen people that are 70 plus refi their home, right? So does that mean that they're going to finally pay off their home at 100? Maybe, right? Unless they have a plan. They live off of borrowed money. That's a mistake that's commonly out there as well. So they don't have enough money coming in. So, they're living off of credit cards and lines of credit and whatnot. Number four is buying a new car. I mean, everyone needs to buy a car, but the point on this one is, are you buying a car that is above what you really can afford? Or what are you prioritizing your car over something else? So keep that one in mind when you're thinking about what kind of ride that you need. Spending too much on your house. The example that I'm reading here on this website here is that you're buying a 6,000 square foot home for a family of three. Might not be needed, right? If you've got the money, that's fine. But what if you can only afford a home that is 2,000 square feet, but you're buying that 6,000 square foot house, which is way above what you're making, but the bank somehow is going to give you financing on that. Number six is using home equity line like a piggy bank. And I mentioned that one earlier. You're borrowing money again to buy things that maybe you shouldn't be buying because you can't afford it. So you're putting it for the long term, right? You're using interest and you're using lines of credit or personal loans to do that. But at some point, you're going to have to pay that back. And when you pay it back, it's going to cost you a lot more. If you bought something for 5,000, it might cost you 10,000 by the time you get done with the payments. Living paycheck to paycheck is number seven. And, it's in June of 2021, the US household personal savings rate was 9.4%. So what that means is many people, like the majority of the people that are living paycheck to paycheck. So either you have to increase your income or lower your cost to be able to manage your budget and try to get to that point where, if you missed one paycheck, you could survive. And then I could miss two paychecks and I could survive. Maybe your goal is then I could miss 6 paychecks and still have enough money to run my life, or not have any debt in the first place, or overwhelming fixed cost, right? Things that are there every single month that we've built up. Number 8 is not investing in your own retirement, because we know that Social Security income is not enough. I won't give up the number here. I believe Rachel or Matt is going to talk about that, about how much Social Security will actually give you as the average person in the United States. There's 40 million people receiving Social Security. What is that average amount that they receive? So if you don't have a pension, you don't have enough Social Security income, you're going to have your own savings for retirement to have a decent, or halfway decent even, retirement life. Number 9 says paying off debt with savings. This one I could go either way on, right? It really depends on what kind of debt you have and how much savings you have. The point here I think would take too long to explain, but one of the causes or one of the reasons they mention that they think this is a problem is if you're doing it from your retirement account, because you've put in money that hasn't been taxed, and then you're pulling it out and you're gonna have to pay it back at some point, right? So let's say you have $50,000 worth of debt and you have enough in your 401k to pay off that $50,000 worth of debt. So you take a loan on it. So you're going to pay yourself back in your 401k, but you are going to have to fully pay off that 50,000. I know a couple of people that had come to me, they left their employer after taking a 401k loan, and their loan was due within 90 days, because once you leave your employer, you have to pay that back. So be careful about rating the 401k. Not having a plan is number 10. I would probably put that as the number 1 issue. This particular website that I was looking up, it says, you can spend hours watching TV and Netflix and whatever else you're watching and spending time doing things, but you can't spend 2 hours a week on your finances, right? That's what this says. And I was thinking to myself, what about 2 hours a month? Does the average person give that much time? What about 2 hours in a year? Do people actually consider, like, sit down and say, what is my financial plan, right? So that's a top 10 list. Hopefully most of you that wanted to join today that RSVP'd are here now. So we'll officially start. Again, thank you. This particular presentation is about health savings accounts. And there's so many benefits of health savings accounts. That's why we wanted to talk to you about them. So welcome to the presentation today. We have 2 of our team members from Saturna here with us as well. And we're happy to have them because they have a lot of experience in customer service and in other things as well. We have Matt Ward, who's been with Saturna Capital for 20 years. He's the distribution and client broker relationship manager. And so what he does is he speaks to not only clients, but he speaks with other companies that you can go buy your funds at, right? So for example, if you want to buy Amana funds within your 401k at another company, you can do that because Matt has signed up that agreement. And so we're happy to have him here because he's been with us for 20 years. He's talked to many, many customers and has oftentimes dealt with some of the stickier types of questions or situations that customers are in, and he's helped to solve those as well. In the beginning, when I first joined in 2008, I used to go to him for questions, and eventually I started going to him for HSA because he was there at the start when we first started to offer the health savings account. Rachel Gottleib is with us, and she is the manager of the retail investor services team. So her team is the group that will answer your questions when you call in, right? So if you call into Saturna, it doesn't go to some other country, to some customer service company that we've hired. We actually hire the folks ourselves. They're in our main office in Bellingham, Washington, where Rachel is. And Rachel's team is well-versed on not only health savings accounts, but all of the different types of accounts that you may need. So we'll have both of them speak here today. Oftentimes we have tax advantages that are out there for us, but we just overlook them. And so what we want you to do as our customers or potential customers is whenever you have a financial goal, try to figure out an account type that the government allows that will allow you to have a tax benefit. If I asked all of you on the call here today, how many of you are concerned about health insurance cost and dental costs for your children, maybe vision for one of your children, or maybe for yourself, probably 50% or maybe even all of you might raise your hand and say that's a concern either now or it's a concern in the future. Part of the presentation today is going to talk to you about what are going to be your future cost of insurance when you retire, right? And so how can you use the health savings account to save for retirement time as well? Last thing before we go into the presentation here is you've probably heard of FSA, and there's FSA and then there's HSA, right? The FSA is a flexible spending account and the HSA is the health savings account. in some ways, the HSA is more flexible than the flexible spending account. And we'll get into why that is, but you probably know as the FSA as the use it or lose it account, where you put in, $50 a payroll. At the end of the year, you have $1,200 in this account, the flexible spending account. You didn't pay tax on that money, that $1,200. So the agreement that you have with the government on this and with your employer is that you're going to use all of that money for health-related cost, and you just provide the receipts, right? So if you do that, you're going to spend the money whether you need to or not. You're trying to spend that money, whereas in the health savings account, you don't need to spend it that year. And so there's some benefits here that you may not have thought about. Some of what we will talk about today will include, perhaps we'll get into something about the funds, and if we do, then just understand that risks, objectives, charges, and expenses need to be carefully reviewed by you. And nothing that we're talking about on the investment side, if we get there, will be any kind of guarantee, right? So if we mention an average return of 7% or 8%, that doesn't mean we're guaranteeing a return. We're just telling you what an assumption might be or what past performance might be. Good news that we wanted to share, you probably don't know this, but we get to see this news and we rejoice in it, if you want to say it that way. So Investors Business Daily has been publishing the list of best HSA providers. And for the third year in a row, Saturna Capital was named as one of the top. So we're happy about that. You're going to see why we're ranked, in the top for HSA, and we're glad that we've been able to accomplish what we need to be able to make this list. So I'm going to pass it over to Rachel now, who will get us started with the health savings account preliminary information.
Thank you, Owaiz, and thank you for having me. So we're going to just jump into what is a health savings account. And I want to start with a statistic that I found very interesting. According to the 2020 year-end HSA market statistics and trends, there are more than 30 million HSAs. And that's covering 63 million people and holding over 80 billion in funds. So what's the buzz? What is this HSA account that is growing every year, year over year? So we're going to start with HSA. Well, that's short for health savings account. And when we think of that, we think, okay, it's an account where I pay health-related needs out of, but it's much more than that. It's an account that, yes, lets you pay for those qualified medical needs with tax-free dollars. It can reduce your annual taxable income with pre-tax contributions. It also allows you to save for your future healthcare expenses while generating tax-free earnings. And all of that said, it's providing you peace of mind when you retire. And we're going to talk about that. An HSA is also yours. You own it. So the money is yours until you spend it. Even contributions made by other people, such as employers, all that money is in your HSA is yours. Owaiz briefly touched on the lose it or use it. If you don't use this, you do not lose it. Your HSA is yours for life. So again, there's no use it or lose it rule. The balance rolls over year, and with careful balancing and savings, you have the opportunity to grow your account over time. An HSA also offers tax savings, and we're going to talk about this later on, but HSAs do provide what's called a triple tax benefit, and we'll address that later on. So when we think about the HSAs and we think about medical expenses, it's not just an account for doctor visits. An HSA, once you've contributed to it, you can use those funds in your HSA to pay for qualified medical expenses such as dental visits, vision care, prescription medications, and more. And again, we're going to dive into that as well. An HSA account, that also helps you save money on the high cost of health insurance. And we'll dive into that a little bit later on. We're also going to talk to you about how an HSA account can help you with your financial goals in retirement. So you can tell that an HSA, a health savings account, it's not just an HSA, it's actually a nest egg. You can not simply set aside an HSA in a shoebox or safety deposit box. You have to have an account that's specifically designed to hold a health savings account. So we're on the screen now. Eligibility, excuse me, guys. Client eligibility. So because there are significant tax advantages, the IRS has specific guidelines to determine who's eligible to open and contribute to an HSA. So once you're eligible to open an HSA, like I said earlier, because it remains yours, even if you no longer have what's called a high deductible health plan, which is one of the requirements, you can still keep this account. Eligibility is only required to make the contributions to the account. So I want to make sure we point that out. Let's dive into how to become an eligible individual. In order to qualify for a health savings account, you need to have what we just talked about is a qualifying high deductible health plan. And that plan has to meet the IRS guidelines for the annual deductible and out-of-pocket maximum. We're going to discuss high deductible health plans in just a second, but on this slide, let's go ahead and address the turning 65 in Medicare. All contributions have to stop once you enroll in Medicare. But I do want to point out that once enrolled in Medicare, though you can't contribute to an HSA, you can still continue to invest the money in your HSA and take distributions for qualified medical expenses. Another point to make on this slide is that when it comes to turning 65, if you delay your enrollment in Medicare, you can still make contributions past the age of 65, including catch-ups. And again, I know I keep saying we'll talk about this later on, but we will. We'll talk about catch-up contributions in a minute. Last but not least, I do want to mention that there are no income limits income limits to be eligible to contribute to an HSA, and HSAs can be 100% tax deductible at all income levels. All right, so we just said that to be eligible, you have to have a high deductible health plan. So what are the rules? What is this all about? Well, a high deductible health plan, as you see here, HDHP, lots of acronyms we're throwing out today. What is this high deductible health plan and what makes it qualified? So under tax law, qualified high deductible health plans, HDHPs, they have to set a minimum deductible and maximum on out-of-pocket expenses. For a single person in 2020, the minimum annual deductible is $1,400 on that high deductible health plan, and the maximum out-of-pocket is $7,000. For a family in 2021, the maximum annual deductible is $2,800, and your maximum out-of-pocket can be $14,000. What's the minimum deductible? The minimum deductible is the amount you're going to pay for healthcare items and services before your plan starts to pay. So what's the maximum out-of-pocket? That's the most you'd have to pay if you need more healthcare items and services. Now, like most plans, an HDHP, high deductible health plan, generally covers 100% of qualified medical expenses once you've reached your annual out-of-pocket maximum. And that's how you're protected from large and unexpected healthcare expenses, right? Well, some plans, you might hear this being called the stop loss limit. The out-of-pocket maximum is the upper limit of your financial exposure during a plan year. With some high deductible health plans, the out-of-pocket maximum and the deductible, well, those are going to be about the same. With high deductible health plans, the amount you pay for in-network deductibles, co-payments, or co-insurance, but not healthcare insurance premiums, are going to be included towards your out-of-pocket maximum. Now, with exactly what your plan covers, that's going to depend on a lot of variables. Your employer, your health plan, and the different choices you make from among the plans available to you. I do want to call out while we're on this slide that since 2011, health savings accounts, qualified high deductible health plans are required to pay 100% of standard preventive care services as designed by your health plan. So if you take advantage of preventative care services, adopt healthy lifestyle habits, you can reduce your medical expenses, potentially increasing your ability to pay for those healthcare costs in retirement. All right, if we want to go to the next slide. So we've talked about what an HSA is, more than just a health savings account. And we talked about how to become eligible and what this high deductible health plan was. Let's move on to HSA contribution limits. Because these accounts have a unique tax advantage, I mean, your contributions are protected in most states from state and federal income taxes. And because of this, the government limits the amount of money you can contribute each year to your HSA. I want to call it, if you do contribute too much, you may pay income tax on that additional amount, as well as penalties, okay? So as long as we stay within the government guidelines, we are good. Each year, the IRS does set those contribution limits for the next year. And the limits for the high deductible health plan coverage for individual and family are the most that you can contribute every year. So let's talk about what those are. In 2021, $3,600 for a single plan and $7,200 for a family plan. And remember, the single and the family plan, those are going to be based on the deductible from your high deductible health plan that we discussed earlier. So the max you can contribute, again, $3,600 for a single and $7,200 for a family. With that being said, as an added bonus, there is what's called a catch-up contribution. So if you're 55 years old or older, you can contribute an additional $1,000. And you can do this every year as long as you're eligible for the HSA. But again, as we discussed on that first slide, if you enroll in Medicare, you're no longer permitted to make those contributions. So what does these catch-up contributions do? Well, if I have a single plan, I'm not capped out at $3,600. I can make that additional $1,000, allowing me to do a contribution up to $4,600. All right, who can contribute to an HSA? Anyone can contribute to an HSA on behalf of an eligible health savings account, HSA account holder. Now, I want to point out that although anyone can contribute to your HSA, it's only you and your employer that may be able to claim a deduction on your contributions, okay? They may not take a contribution. If you have a family member making a contribution for you, they may not take that tax deduction. But the nice part of that is their contributions to your HSA do not add to your gross income. So when we start talking about taxes and different strategies, keep that in mind. So if you're contributing using taxable income, for example, if you have an HSA health savings account not associated with your employer's health plan, your contributions can be included as what's called an above the line deduction. So when you file your federal income tax, this can reduce your taxable income. Well, what if you're self-employed? Well, because self-employed individuals, they're not considered employees. They can't receive employer contributions to their HSA from their businesses, but they can make personal contributions and may be able to claim those on the above the line deduction that we just talked about on the income taxes. IRA transfers. This is going into rollovers and transfers. When we talk about rollover transfers from an existing HSA that you may have to an HSA with a different trustee, those don't contribute to your annual contribution limit, but there is something called a once per lifetime trustee to trustee transfer from an IRA. So to help fund the HSA, an account holder can make a once per lifetime trustee to trustee transfer from a traditional or a Roth IRA to an HSA. I do want to point out that this transfer will count to the annual contribution limit. And because of that, the once per lifetime IRA to an HSA transfer is limited to the maximum annual contribution for the year. And then the tax window, you can contribute up to the tax filing deadline for the year. For most people, that's going to be April 15th of the next year. I do want to say that if you have a tight budget and can't fully fund your HSA, remember that most plans allow you to make contributions beyond the end of the year. So until that tax filing deadline, and still receive those tax benefits. All right, triple tax advantage, save those receipts. So let's jump into what is a triple tax advantage. Only HSAs provide what is known as the triple tax advantage. And what are these three advantages? Well, if you follow the rules, the three tax advantages are: you can make tax deductible contributions, your account can grow and generate earnings free of federal, and again, most state income tax, and your distributions, when used for medical expenses, are also free of taxes. So let's talk about these three advantages briefly. Every dollar that you contribute pre-tax to your HSA reduces your annual taxable income. What does that mean to you? What's the benefit to you? Well, you're going to keep more of your paycheck with pre-tax contributions. One of the benefits of an HSA is that no taxes are withheld from HSA contributions made through payroll deductions. So every dollar that you contribute from your paycheck is going to go directly into your account. That means you could have more money to use on qualified health expenses than if you were to use funds from, let's say, your checking account. So with that being said, contributing funds to your HSA on that pre-tax basis not only reduces your income tax liability, but it can also reduce other employment-related taxes. So tax advantage number two, we said tax-free earnings on your money. Your account and your investment earnings grow tax-free. Any earnings on your account are tax-free, which could add up to more dollars to use towards qualified health expenses, to save for retirement. This is just one reason why utilizing the investment features of an HSA could be an important component when we talk about long-term financial planning. And number three, tax-free distributions. Anytime healthcare expenses come up, if you pay for it from your HSA, you're good to go. As long as it's a qualified medical expense, you'll never pay taxes or penalties when you use those HSA dollars. So when you contribute to a tax-advantaged account like a 401k or an IRA, you can expect to pay taxes on the money once you begin taking withdrawals, right? But that's not the case with an HSA. You can make tax-free withdrawals from your account to pay for qualified health expenses, and that is tax-free. All right, if we want to move to the next. All right, so why do I want to open one? On this slide, it reiterates that the money is yours. And if you remember, we talked about the use it or lose it, and that is not the case with an HSA account. It is your money. But today, a health savings accounts, HSAs, they provide more tax advantages than any other savings vehicle in the United States. If you don't have an HSA and you qualify for one, you might be missing out on an opportunity to, as we discussed, reduce tax burden, increase your retirement savings, and really protect yourself against rising medical costs. So more than it's just your money. Again, you've got to be an eligible individual to open or contribute to an HSA, but you do not have to be covered under the high deductible health plan to keep the account that you opened. You can still accumulate tax-free earnings or take tax-free distributions for qualified medical expenses. You get to keep, grow, and spend all the money in the account, even if you leave your employer or you lose your HDHP. That was the high deductible health plan. We briefly mentioned saving on the high cost of health insurance by saving on premiums. I just want to touch on that because when it comes to choosing a healthcare plan, you really have one decision to make. It's going to be high premium or low premium. And as we discussed earlier, the HSA qualified high deductible health plan, well, it offers the lowest premiums. That enables you to unlock immediate savings. The difference could actually be thousands of dollars a year. Healthcare premiums, I want to get across, they disappear forever. So you don't benefit financially because there's no refund of unused premium payments. But you can use your HSA to keep that money instead. So a higher deductible generally means lower monthly payments as far as your premiums go. And while it may seem intimidating to take on a higher deductible, remember that high deductible health plans may actually save you money over time. If you contribute all or some of what you're saving by paying a lower premium, you put that into your HSA, the balance in your account, in your HSA account, could offset your higher deductible. When you contribute more than what you need for medical expenses in any given year, contributions in your HSA can grow year over year. So in a nutshell, if you choose a low premium health plan, you can put the extra money you would have paid towards a high premium plan into your HSA, and this gives you more flexibility and control when it comes to saving for future healthcare expenses.
Rachel,
Well,
question for you. So some employers, I don't know if you know the percentage or if you just know just generally, many employers do put some money into your HSA savings account when you sign up for HSA health insurance plan versus a higher end plan. Is that right?
Yes, absolutely. So there are a lot of statistics out there. I'm reading last night that companies with less than 500, 75% of employers contribute. And so why would employers want to do that? Well, HDHPs and HSAs provide a means of controlling soaring healthcare costs in a way that does not impair employees' access to quality healthcare. And besides saving money on overall reductions in premium costs, employers also pay fewer taxes because contributions to their employees' HSAs are tax deductible. Okay. When a company provides an HSA, they realize a tax savings because their payroll taxes could be reduced. Mm-hmm. So they're saving on things as well as the employee on FICA, federal unemployment tax, state unemployment tax. All of these taken into consideration when employers are looking at it.
I believe this is Rachel's final slide, perhaps, or maybe one more after this. So just a reminder, if you have questions that are coming up in your mind now, go ahead and put them into the Q&A portion or the chat portion of this webinar, and we will address them shortly when we're finished. Please continue, Rachel.
Yeah, like we said earlier, it's not just for doctor visits. And this is just a small example of what can be considered a qualified, allowable expense. There's great publications out there. The IRS offers publications, I think 502 and 969, it talks about qualified medical expenses. This is just some of them so you can see that it's not just about doctor visits. All right, next slide. All right, and then I'm going to introduce Matt here. On this slide, I just want to say that even with the passage of the Patient Protection and Affordable Act and changes in Medicare, healthcare costs are still going to rise significantly, especially in retirement. Industry analysts warn that many retirees are going to fall short of the amount needed to cover the gaps in medical coverage as they age. Matt is going to jump into this and take over. So without the HSA, I just want to throw out there that many retirees are going to have to pay for their share of medical expenses by taking distributions from their 401ks and other retirement savings plans. And as we know, these distributions are taxable. So thank you very much.
Thank you, Rachel. All right, Matt.
Hello, everyone. I just want to thank all of you for taking the time out of your day to be here today. A number of you I've probably, if you've been with us at Saturna for a while, we've probably spoken or crossed paths. But again, I just want to thank you, and thank you always for having me today. This has been, as Rachel has laid out very well, the HSAs are very much growing in popularity. And also, as she's laid out well, as one of the primary takeaways I want you to have is that the insurance has to make sense for you, okay? High deductible health plans are fantastic. Rachel's done a great job of spotlighting the benefits that they can have. Even if maybe you're a little bit skittish about having that higher deductible, the tax benefits and getting a little bit of a ramp up into an HSA account once you build up a little bit of savings can really give you a nice runway. And but again, the insurance has to make sense for you, and we just hope to give you that primer, just because that's always first and foremost. I've had a number of conversations with clients and prospects over the years that say, I'm ready to get it going. I'm like, well, that's great. I want to walk you through every step, but have you figured out the insurance portion? And they're like, well, no, do I need, so just always remember that you just need to have that qualification before you begin to take steps to open up an HSA. The last thing that you want to have happen is to have the IRS knock on your door. You just need to make sure that you're qualified for the account prior to making any contribution to it. So always, if we could hop to the next slide, please. Our marketing group put together a couple of statistics here, and one from the Employee Benefits Research Institute and another from Fidelity. Their numbers are slightly different in their estimates, but this is really pointing out something that I think we're all fairly aware of. But it gives you a picture in terms of dollars with respect to estimated healthcare costs, which everyone knows just kind of steadily increases over time, or has. The old joke, I'm not sure if this was a Mark Twain, like Owaiz was referencing earlier, but whoever said the two certainties in life are death and taxes. Well, if we stay above ground, medical expenses as well, right? So this isn't, these figures aren't certainly shocking anyone, but we just want to point out just how important it is to save what we can for what will be an inevitable source of spending in the future, and that is on our medical care. As well as, so Social Security, and as Owaiz touched on it earlier, this is the average number. This is another number that isn't going to surprise anyone, as far as understanding that Social Security certainly isn't going to take care of everything for you. And you do need to find a way, we all need to find a way to put into savings what we can for various future goals that we're going to need to cover from other sources. So in 2004, Saturna started offering HSAs, and I'll give you a real brief overview here on how that came to be. So the institutions that were initially putting this product out on their shelves were banks, and a number of you probably remember that. It was essentially a checking account with a debit card with an HSA label on it. You earned about 1% on the balance. Paid that much probably in fees, and swiped your debit card at the doctor's office. Very transaction oriented. That absolutely is a suitable fit for certain people. We decided that there, and time has shown us that our hunch was generally correct, that there's another type of HSA prospect, and there's those that want to take advantage of what Rachel was describing earlier with respect to the excellent tax treatment of the account, and that you can offer investment options within these accounts. Okay, so as an investment advisor, Saturna Capital, a number of you know we have IRA products, different retirement account products, you name it. We've got a broad spectrum. We added health savings accounts to our product lineup, and whereas someone could come to us, set up their HSA, and invest, rather than have that checking account style that I referred to at the initial here. So as many of you know, we offer and advise and distribute the Amana mutual funds, which invest consistent with Islamic principles. We also have a number of other mutual funds that we advise and distribute as well. We also have a brokerage option as well. So this Saturna was what I don't want to say we were the lead, but we were one of the primary trailblazers that took this approach when these products were available to come to market back in 2004. And we really started to attract attention of those that were looking to take advantage of the savings and to grow their balance over time. I'll just say that last bullet point there that you see, we have very low minimums to get started in terms of initial investment. So I touched on this briefly. We have a number of no-load mutual funds. The number of no-load mutual funds just means there's no commissions when you buy or sell those funds, okay? But they all vary with investment objectives because everybody has different investment objectives. Some of us want to play it close to the vest. We maybe have a shorter term time horizon. Others may want to put their foot on the gas and invest more aggressively. To each their own. And with respect to allocating amongst just the Amana funds to invest consistent with Islamic principles, I want to give a little plug to a tool that we have on our website, which is absolutely fantastic. It's called the Amana Fund Selector. The Amana Fund Selector. And what it is a tool, it's an educational tool that allows individuals to plug in, I want to say it's about 10 questions or so. It just takes a few minutes to fill out, but you're essentially answering questions that revolve around your goals, your time horizon, and your risk preferences. And you can plug that in, not just for our HSA. We put on your HSA cap, I'm saving for future medical expenses cap. That might be different from your long-term retirement savings cap. But the point is that you can use that tool, answer those questions. And what it does once you're done is it displays a hypothetical allocation amongst the different Amana funds that's based on the feedback that you provided it. So one might be a very conservative approach to investing, one might be very aggressive. Once you take the steps and go through that exercise, you'll see what I mean, but I just wanted to give that a quick plug. As I mentioned, investing, there's a broad spectrum of different investments that you can have which tailor to your risk returns and objectives. We also have a self-directed brokerage option should you decide to purchase individual stocks, money market funds, or unaffiliated mutual funds.
So Matt, let's stop here for a second because you brought up some interesting things about in 2004 when they first came out. Many people were using it like the FSA, which is put some money in and then use it all up in that same year. But the other way to do it is to put it into an investment. So how does that work? So if someone puts in, let's say, 5,000 per year, they don't put in the maximum family 7,200 or whatever the number is there. They put in 5,000 a year, and their expenses are around $1,000, and they're able to absorb that from their, write checks from their checking account. What are the advantages of doing something like that? Yeah,
so that's a great question. It's one of the things that people have figured out. Either before they come to us or after we're having a conversation about what the Saturna HSA is and how it's different. It's a reimbursement vehicle. So to stick with your hypothetical, let's just say an individual puts in $5,000 a year for 4 years. Let's keep this real simple, and let's just say that they have, whatever, like 25,000 in the account. Let's assume there's some appreciation there. Over that time, like you said, they've gone to the doctor. Let's say they've allocated or they've incurred about $1,000 a year in medical expenses. Okay. Now, earlier you saw Rachel's reference to save those receipts. Now, that is absolute gold as far as something to keep in mind. You absolutely want to save your receipts if you're planning to reimburse yourself next week or you're planning to reimburse yourself in 5 years. That's one of the great things about this product, and it ties right into your example Owaiz, is that this is key too, and don't worry, because we'll talk you through this. If you're interested and you call us up, we'll walk you through this. But it's extremely important to remember this. Only health expenses or medical expenses that were incurred after the effective date of the HSA being established are eligible to be reimbursed from the HSA. I've had a number of conversations over many years where individuals will come up and say, yeah, I'm all set. I've got my insurance ready to start up my account. I've got to reimburse myself for some dental work that I had done last month. Now we don't require receipts to be sent to us, but, and I'm not going to, it's not our job to oversee that. That's the IRS's job, but I do give them a friendly reminder that only expenses incurred after the account can be set up, can be reimbursed tax-free and legally. But always getting back to what you said, there's a number of individuals that will wait to reimburse themselves years down the road. Let's say after that 5 years, they've got that $4,000 ready to go, but they've been paying out of their own pocket the whole time. Well, that's still, those receipts are good to be reimbursed later on down the road. So they may cash in that $4,000 and fly to Maui. They've already paid the medical expenses, but those are good for tax-free reimbursements from their HSA at any future date and time.
So the 5,000 they're putting in, they're using 1,000, but they're not pulling it out of the HSA. That 1,000 they didn't pull out is able to grow, right? That's the whole objective.
Exactly. And someday when you decide those receipts that have not yet been reimbursed from your HSA, that end up to be amounts that you've reimbursed from your HSA, they can be reimbursed down the road at your choosing.
And like you said, they don't need to provide the receipts to us. They have to hold on to them in case they get audited by.
That's exactly right. If the IRS ever came knocking, you would just, because they're tax-free distributions, I don't know if that gives the IRS more of an incentive to want to ask about those things. But if let's just say I was holding on to receipt, I actually have an HSA and I try to reimburse myself from it as little as possible, because someday my better half is going to want to, use it for something. Well, that number, whatever that is, might be a significant number in 10 years. As soon as life doesn't throw me any major curveballs and they're just routine medical expenses, but that could be a significant number that comes out maybe. I want to have every receipt ready if the IRS says, hey, Matt, what's this $12,000 you redeemed tax-free from your HSA? A lot of people do that. It's Saturna, and not just Saturna, and other places as well. So that just kind of is a quick hypothetical why we emphasize the importance of holding on to those receipts. You want to make sure every single one of them reconciles with your distributions.
I did get a question from someone about, what if they don't have a receipt? Well, you can call up the dentist. They usually will send you a year-end recap. You call up your doctor and they'll say, okay, let me get my assistant to send you something. So you can go back to those if you've forgotten to save them, and just make sure at the end of the year, when you're doing your taxes and you're putting your paperwork for your taxes, have a folder for your HSA receipts as well. Have a folder for your donations that you make, so you can take care of your responsibilities with the government as well. And now we're moving on to personalized service.
Yeah. So Rachel and her team does an excellent job of helping individuals that know very little about HSAs, and then of course our existing clients, everybody under the sun, as far as any questions that they have. Rachel's team is here to service them. There's no silly questions with this product. They can get they could be a little bit complicated, as we're giving you a lot of information here. But there's really only a good handful of main points to take away. But we are here to answer every single one of your questions. I've given I've spoke to some of these points already, and I don't want to take up too much airtime here than is needed. But I will just say that last point. I mean, it's very easy to set up automatic investments into your HSA via ACH and our other products as well.
And there's a couple of different ways to go, to the audience, right? You want to write a check every year for $7,200, fine, right? If you have a lot of money in your account, you're okay with writing a large check like that. What I like to do, and what I like to tell our clients that are talking to me directly, is to set up that automatic contribution for a couple of reasons. One, you don't forget to make that annual contribution. Two, it's not a large hit every year, $7,200. And three, you're dollar cost averaging into your investment, right? So if the price of the Amana share that you're buying, I'm just going to make up a number, is $50 a share at the beginning, and you're putting in $100 every time, you're buying 2 shares. But if it goes down to 45, you're buying more than 2 shares. So that's one of the ideas I would say, is always dollar cost average. What happens when you turn 65, right? Because something does happen. Who wants to address that?
I can touch on it.
Okay, please.
Rachel kind of put the primer on earlier, I mean, she made references to when you go on Medicare, you're not allowed to contribute to your HSA anymore. The reason why that is because it's similar logic. Even when before you reach Medicare, if you were to say, I'll give you two hypotheticals. One, you go on Medicare, that's supplemental insurance, it's added insurance. To be eligible to contribute to an HSA, you can't have any other source of insurance. Okay, so even if I have a qualified high deductible health plan that covers myself and my family, if I piggyback off of my spouse's plan through her employer, that makes me absolutely ineligible. So whether it's Medicare you're adopting, you drop the insurance that greenlit you to make contributions to begin with, or you keep that insurance, and like I said, I piggyback off of my spouse's insurance or have some other sort of source that makes you ineligible to contribute. Got it.
All right. Thank you. And we skipped over a couple of the pages there so we can get to some of your questions. We're running a little bit long. If you want to take a screenshot of this particular slide, you can find Rachel's extension and Matt's as well as mine and my team also. So please take a screenshot, contact us, email us, ask us further questions. I don't see too many questions in the chat groups at this point, which maybe means that we've addressed a lot of them already. There was a question, let me see if I can go back here. There was a question about eligibility. So I'll just put that up on the screen for the person that asked so they can take a screenshot of that while we go through some other questions. Rachel, I have a question for you. So, like these individuals that already have an HSA, they have a high deductible health insurance plan, and they come to us and they want to open up either an investment account through mutual funds, usually Amana funds if they're Muslim clientele, or perhaps some of the other funds as well. But they might open up a brokerage account because they want to buy individual stocks or some other funds that we don't carry. What about employers though? Like what if an employer is listening to us today and they have 10 employees and they have a high deductible health insurance plan? What can they do with us?
Well, employers who want to offer HSAs to their employees, I mean, it's smart and savvy because it helps with retention and giving your employees the ability to have control over their health care and rising costs, right? If the employers out there, if somebody is interested in doing that, we will definitely sit with you, go over different paperwork. We do streamline it to the best of our ability and simplify the process, but we do open those and for their employees. We do take contributions for the employees, and we do have several existing employers that do offer HSA plans to their employees.
Got it. All right. So if either of you have anything, you can speak about it in a second after I just mention a short recap here of why I like the HSA so much and why we're talking about it today. It is triple tax advantage, as you heard. So you can't get that with a Roth or a traditional IRA or even education savings account or SEP or 401k. So this is the triple tax advantage. The difference here compared to either the traditional or the Roth IRA, both of those give you one or two different possibilities, right? So the traditional IRA gives you the tax deduction up front, and then you don't pay taxes along the way. But when you pull out the money and let's say you've saved up $1 million, you're going to pay taxes on the full $1 million at that time. The Roth IRA, if you reach $1 million at the end or whatever the number is, you won't pay a dime in taxes, which is beautiful. And you didn't pay taxes along the way on the dividends or sales that you made. So you have two tax benefits there, but you didn't get the third tax benefit, which is a tax deduction right up front. So that's why we say the HSA is a special type of account. The reason why it's there is because the government knows that they cannot take care of all of us in terms of healthcare, right? So they're trying to give us advantages, tax advantages, to be able to save on our own. That's the same thing they've done with the 401k, right? They've made it tax advantageous, so we would take care of it. The other reason I do like it, we at Saturna, we use an HSA for employees as well. For those that want to sign up for that, they can have the HSA or a regular insurance plan. For those of us that have signed up for the HSA, we've built up balances in there, right? Our employer contributes a little bit, we put in some money, and then the investment, will do its thing. And so, we've been able to have some money there. And so you start thinking about it and you say, well, if this grows into a large amount of money, I may not ever use it just for health insurance costs, right? So what else can I use it for? We talked about this. When you turn 65, it turns into it basically will be the same as a traditional IRA at that point if you're withdrawing. So let's say by that time you have $150,000 in the account, and you want $25,000 for whatever you want it for besides healthcare. You can pull out $25,000, and you will just pay taxes on what you pull out. So you pay taxes on that $25,000. There's no penalty. Even though you didn't use it for healthcare costs, there's no penalty. I'll give you a personal aside, and then we'll turn it over to Matt and Rachel if they have any closing words. Is that since I've started this personally, I've been able to use it for my children's orthodontic work and other dental costs that come up, vision as well. I like telling people I have one bionic eye, so that was paid for by this great HSA where I was able to build up balances. And I do use this strategy most of the time where if I have small bills that I'm paying, I write the check, I save the receipt. At the end of the year or maybe next year, I'll look at all my receipts and say, all right, you know what, this is a good time. I'm going to go pull out all this money and then I'm going to go spend it on something else. So there's some real great flexibility points on an HSA. Matt, Rachel, if you have anything final, otherwise we will wrap it up.
I think that, reading through statistics and data, one of the hardest challenges for employers with getting employees to open these HSA accounts so they can take advantage of the tax savings is the convoluted amount of information there. There's a lot of information there to absorb and digest. And here at Saturna, we want to make that as easy as possible for you. While we're not tax professionals, we don't offer legal guidance. We will answer your questions. If we don't have the answer, we will hunt it down for you. So if after this meeting you do have any questions, please feel free to reach out. I know Owaiz put our contact information up, but if you are eligible and not taking advantage of opening an HSA, you really could be missing out on the opportunity to reduce that tax burden and increase your retirement savings. And like I said earlier, protect yourself against the rising costs of medical. So with that said, thank you for allowing me to join you today. And again, information is out there, so please let us answer your questions.
All right.
I would echo everything that they both just said. We just appreciate you guys, and we're here to help with any questions that you have down the road. Appreciate you taking the time out of your day today. And yeah, it really is a fantastic product. If the insurance works for you, it's the only source of insurance that you have. If you're already kind of in that boat with some people, they're already investing in a high deductible and they don't even really quite understand that the HSA is their good friend that's been kind of walking there, in the shadows the whole time. It's really is a really nice product if it suits your lifestyle and it meets the insurance needs.
Thank you both for joining us, and for everybody else as well that joined us to listen. And you may a couple of people have asked me, where do we get this? Because I joined late. Where do I get the recording? So in a few weeks or so, it'll be on our website on amanafunds.com or saturna.com. But if you want to find it easily, you can just go to your search engine and punch in Saturna webinars, and you'll find the past ones we've done as well on 401ks and education savings accounts and trust and specific mutual funds that we offer as well. If you think that some of your friends or family, your children, your nephews or nieces, right, grandchildren might need some of this information, they're just not listening to you, might want to share a video with them. You can share one of those webinars or one of our Halal Money Matters podcast as well. Again, thank everyone, and we'll see you next month for our next webinar. Thank you very much.
Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information about the Amana Funds in a current prospectus or summary prospectus, please visit amanafunds.com or call toll-free 1-800-728-8762. Please read the prospectus or summary prospectus carefully before investing.